Hi, I'm Mason Case, and for my Bloomberg-based project, I decided to compare the industries of the oil and gas industry and the biotech industry. Starting with the oil and gas industry, the companies I decided to use are ExxonMobil, whose industry symbol is XOM, Chevron Corp, CVX, ConocoPhillips, COP, Hess Corporation, HES, and Marathon Oil, MRO. Next to all these industries, you can see their corresponding current stock prices. Right here, I have a table of the enterprise value of each of the companies. The top row shows the enterprise value 5 years ago, and the bottom row shows the current enterprise value. As you can see for Exxon, their enterprise value has slightly increased. Chevron's enterprise value has increased by a good amount. ConocoPhillips, Hess Corp, and Marathon Oil, however, have all shown recent declines in their enterprise value. This right here is a sheet of information from Exxon pulled from Bloomberg. As you can see, their revenues, gross profit, EBITDA, net income, and earnings per share have all been rapidly declining over the past few years. Looking at Chevron, it's a very similar case that's happening. The revenues, gross profit, EBITDA, net income, and earnings per share are all dropping, with gross profit even going negative in the most recent period. ConocoPhillips' numbers are also seen declining. Just like Chevron, you can see that their gross profit hit negative in the most recent period. However, their net income and earnings per share also broke negative. Hess Corp dips as well, as though you can see their earnings per share is actually the lowest out of all the companies at negative 5.41. Marathon Oil's numbers also drop, as though something to notice here is that their net income has been negative for a longer period of time than the other companies. Their earnings per share also hit negative for the past few periods. Now looking at the profitability and returns that these companies make, Exxon appears to have had previously very exceptional returns on assets, equity, capital, and invested capital. However, in this most recent period, while they still have relatively high returns, it appears to have diminished greatly. Chevron, very much like Exxon, has had very exceptionally high ratios in previous years. However, these most recent years it's dropped dramatically, and they even hit a negative return on invested capital in this most recent period. ConocoPhillips' returns have dropped just like the rest of the companies in this industry, although their latest period returns have all appeared to be very negative. Looking at Hess Corp's most recent period, they've actually dropped much more than ConocoPhillips has, reaching their return on common equity dropping as low as negative 14.7, negative 8.42 for return on assets, negative 10.07 for return on capital, and negative 9.76 as return on invested capital. Marathon Oil's returns have also dropped into the negatives, just like Hess Corp and ConocoPhillips. Looking at the DuPont analysis for Exxon, some important things I want to point out is first the asset turnover. Exxon tends to typically have the highest asset turnover over all the companies in the oil and gas industry. The leverage ratio for all companies is also actually relatively similar. All of the periods for each of the companies have a leverage ratio of between 1.7 to no higher than around 2.3. Exxon also, you'll notice, has the highest return on equity out of all the companies. 5 years ago, they had a return on equity of 23.83, and now in this most recent period, it's dropped to 9.36. However, it still remains the highest return on equity out of all the companies. Chevron Corp's DuPont analysis sends similar information as Exxon's does. Their asset turnover, while lower than Exxon's, has dropped over the most recent periods, and their return on equity has also dropped, although their return on equity stays above zero. Looking at ConocoPhillips, the first thing that you might notice is their negative return on equity. This number is very much driven by their negative operating margin. ConocoPhillips also has the highest leverage ratio out of all the companies, resting at around 2.3, so it's causing them to magnify their gains and their losses on the return on equity. Hess Corp, like ConocoPhillips, also has a negative return on equity. It's driven by a negative 59.03% operating margin. Also, you'll notice that their asset turnover in this most recent period had dipped as low as 0.18. This asset turnover shows that they're making very poor use of their assets. Marathon Oil has actually been suffering for an extra period longer with a negative return on equity than Hess Corp and ConocoPhillips. You will also notice that their asset turnover ratio dips actually below Hess Corp's 0.18, and they're resting at a 0.16 asset turnover ratio. Looking at the dividend yields for the companies, Chevron and Exxon both have the highest yields, with Chevron being the highest at 3.82%. These higher yields might help out, especially looking at previous information about how the negative turn that the oil and gas industry has been taking. So investors might see it as a better opportunity to receive more of their money early than hoping for a future payback. For the capital structure in the oil and gas industry, on this table I have listed the percentages that make up the equity, debt, and preferred equity of each of the companies. Exxon and Chevron both consist of high equity capital structures and lower debt, while ConocoPhillips, Hess Corp, and Marathon Oil both have a larger amount of debt. Hess Corp, however, is the only company that sends out preferred equity. In this economic value added table, I showed on the top row the past economic value added of 5 years ago, the current economic value added for the most recent period, and the economic value added spread. Exxon and Chevron have both had positive economic value added 5 years ago, and they've surpassed expectations then. However, in most recent periods, they've dipped to have a very low economic value added. ConocoPhillips, Hess Corp, and Marathon Oil, while also having a negative economic value added in this most recent period, has actually been suffering for a longer time, even long enough to 5 years ago, as reaching negative expectations. Looking in the supply chain for each of the companies in this industry, for the suppliers and customers, Exxon and Chevron both have exceptionally high suppliers and customers, so they can be seen as relatively safe from if anything would happen to each of these individuals' customers or suppliers. ConocoPhillips is also seen as relatively safe. Hess Corp and Marathon Oil, however, have a very low number of customers, especially Hess Corp. So if anything were to happen to those individual customers or corporate entities that are their customers, it could have a serious impact on their own organization. Looking at what analysts think about what these companies, you can see that they have good expectations for the future of the oil and gas industry, although it's not looking good and it's on a downturn at the moment. You'll see that they believe that Exxon is more fairly priced, since more of the analysts are spread out between buying, holding, and selling the stock. Chevron, ConocoPhillips, Hess Corp, and Marathon Oil, however, have some more positive expectations, with Chevron having the most positive. To find out how these companies might do in the future, I looked up target prices for each of these companies. To find these target prices, I used the formula of the average price earnings ratio over the previous 5 years, the estimated multiplied by the estimated earnings per share over the next period to find the target price. Exxon's target price has dropped very slightly over what its current price is. Chevron was the only one that I looked at that my estimates came for a positive price increase. ConocoPhillips' drop that I found was heavily loaded by a very small estimated earnings per share. Its price seems relatively unreasonable to assume, although I can't assume from it that the price is looking forward to dropping. Hess Corp and Marathon Oil, however, their prices are actually impossible to match. They both received negative stock prices by this formula. However, while that's impossible, it shows bad ideas for the future, since their estimated earnings per share were shown as negative, which is what drove this change. Looking at all this information, my favorite company out of this list has to be Chevron. Although it might not have numbers as high as Exxon's, Chevron has a higher expectations of the future that you can look forward to. Although this entire industry is looking to be on a negative downturn, and that there's no telling when it could rise. Now moving on to the biotech industry, I chose all of these companies because they each received 100% of all their revenues from work inside of the biotech industry. The companies I chose are Amgen, or AMGN, Gilead Sciences, GILD, Biogen, BIIB, Celgene Corporation, CELG, and Regeneron, REGN, and I have the corresponding stock prices for each of those companies right next to them. Contrary to the oil and gas industry, the enterprise value for the biotech industry is all positive 5 years ago, and it all has steadily increased until their current enterprise value. With this sheet of information, you can see that Amgen's numbers for their revenue, gross profit, EBITDA, net income, and earnings per share have all been increasing over time for the past 5 years. Gilead Sciences' numbers also show an increase, where their numbers from 3 years ago and 2 years ago actually had a sudden spike of over 3 times their value. Since then, it has also been steadily increasing. Through all of these numbers and information from Biogen, the most notable one of them is the rapid increase in their earnings per share. Biogen has the highest earnings per share out of any of the companies I've analyzed. Celgene Corp continues the trend of the biotech industry's rates increasing, although it does so at a slower rate than the previous companies. Regeneron, while their numbers still grow like all the others, has the slowest rate of growth out of all the rest of the companies. Moving on to profitability and returns, Amgen shows some pretty impressive numbers in this. They've been learning how to use their common equity more efficient for their returns, although their assets, capital, and invested capital, while high, have remained constant throughout the 5-year period. Gilead Sciences definitely has the most impressive returns out of every company that I've looked at. It has, especially this latest period, it has an astounding return on common equity, and also maintains high return on invested capital, return on capital, and return on assets. Biogen is definitely very close to Gilead Sciences when it comes to their use of common equity assets, capital, and invested capital. They've shown significant returns in the 5-year period. Celgene Corp, while looking across industries, has a very high profitability and return. However, when looked inside of the other companies in the biotech industry, their numbers are somewhat lacking. For Regeneron, a big thing to notice is that 5 years ago, for the period ended in 2010, you'll notice that all of their returns are negative. Since then, they've greatly increased their returns to really nice positive amounts. Moving on to the DuPont analysis for the biotech companies, Amgen has a considerable return on equity increase over the previous years to a current value of 26.04. A lot of that value is driven by Amgen increasing their operating margin and their interest burden over time. However, it's noticeable that their return on equity increased despite their most recent periods, their leverage ratio decreasing at the same time. Gilead Sciences has a much higher return on equity than all the other companies. This high number is mostly driven by them having the highest operating margin out of any of the other companies, as well as having a very high interest burden and tax burden. Biogen has the next highest return on equity right behind Gilead. For the past 3 years, its return on equity has been increased significantly. Celgene Corp has a return on equity of 29.66. A lot of this number is due to their very large leverage ratio of 3.57%. However, the reason it's lower than some of the other companies are because their operating margin is exceptionally lower than the other companies. They also have the lowest asset turnover than all the other companies. Each of the companies in the biotech industry's asset turnovers have been very small, although Celgene's is at the lowest at 0.42. Regeneron has the lowest return on equity out of any of the companies in this industry that I've analyzed. A lot of this low number is from their leverage ratio of 1.53, which is the lowest leverage out of any of the companies, and a tax burden of 51.92, which is the lowest tax burden, although they have the highest asset turnover at 0.87. Now looking at the dividend yields of the companies in the biotech industry, 3 out of the 5 companies I analyzed didn't even give out dividends. The only companies that I looked at that gave out dividends were Gilead and Amgen. In this industry, most of the companies supply their funds with equity. However, none of the companies I've analyzed have any preferred equity. Biogen has a substantial amount more than the rest though in equity, with only 8.8% of it in debt and 91.2% of it in equity. Regeneron, though, is much higher than that, with 99.1% of it financed in equity and only 0.9% financed in debt. For the economic value added, companies in this industry all typically were in good standings 5 years ago above expectations, and now they were above expectations. Regeneron was the only company 5 years ago that had a negative economic value added. Gilead Sciences, though, had the largest increase in economic value added, going from 5 years ago at 1,890 to their current number of 12,306.72. Compared to the oil and gas industry, the biotech industry has much less suppliers and customers. Amgen, Gilead, Biogen, and Celgene Corp all have a similar number of suppliers and customers, at around 50 or so suppliers and around 20 customers. Regeneron, however, has a much lower number of suppliers and customers. This makes them much more vulnerable if one of their customers or suppliers would go out of business. Overall, analysts seem to have much more confidence in the biotech industry than the oil and gas industry. The only companies that have lower than a 50% analyst rating to buy it are Amgen at 48.1% of analysts telling to buy it, and Regeneron with 46.2% of analysts asking people to buy it. Following the same model I looked at for target prices in the oil and gas industry, for the biotech industry, my model looked a lot more positive in their growth. Each of the industries looked like they were having sustained growth when multiplying the average price-earnings ratio over the past 5 years by the estimated earnings per share. However, some of the gains seem a little bit unreasonable to assume, like Regeneron growing 178.42%. While this can show that it is predicted to still grow a sizable amount, it seems unnatural that it'll grow by that large. Although all the companies in the biotech industry seem to have a very positive trend going on, my favorite company of this group has to be Biogen. They show the most consistent growth while also showing good increase in values in the enterprise value and economic value added. Also, analysts seem to strongly believe that Biogen will continue its growth. Concluding and looking over both industries, the oil and gas industry and the biotech industry are both currently in completely opposite positions. The oil and gas industry is currently at a downturn, while the biotech industry is quickly moving forward and rising. Over the two companies, my favorite would have to be Biogen in the biotech industry. It's looking good for the future, and it would get my recommendation into what to invest in.